Thank you for joining us today. We're going to talk briefly about the effect of forgiven debt on your taxes. And there's some basic principles that you would need to understand to begin with relative to tax and how forgiven debt impacts those taxes. The basic underlying concept is that whenever debt is forgiven, that debt by the lender can be reported to the borrower, you in this case, as income, ordinary income. And so, for example, if you were to sell a property and the lender had to forgive the debt associated with it, then that amount of forgiven debt would be reported to you on either a 1099-A or a 1099-C, depending on the nature of the transaction, as forgiven debt. Now, obviously, if it's a short sale or a foreclosure or a credit card where some debt was forgiven, you didn't receive the money. That would be phantom income, essentially. But you still have to address what happens with the reported debt. And so, what I want to cover just briefly is how you can approach that. And there are three basic approaches to it. But the short answer, before we even get into it, is this: so long as your taxes are prepared properly, in this environment, when debt is forgiven, you should not have a tax liability. Taxes prepared properly should result in no tax liability in virtually every circumstance. Okay, so let's talk about some different scenarios. The first one would be a piece of real estate. The debt on it, let's say, is $300,000 and the value of the property is $125,000. So when it's sold, there's a deficiency of $175,000. Now, that $175,000 is forgiven debt, and it will be reported to you on a 1099-C if it's a short sale transaction, or on a 1099-A if it's a foreclosure or a deed in lieu of foreclosure. So, what do you do about that $175,000? Well, there's three basic options. The first one, if it was a primary residence, and according to the IRS, a primary residence is any residence that you've lived in for the last 2 of 5 years. Doesn't have to be continuous, just the amount is 2 years out of the last 5 years. So long as that's the case, then an individual can deduct $250,000 tax-free from any sale of a primary residence. And a married couple filing jointly can deduct $500,000 in the same manner. And so in our situation, an individual that short sales a property with $175,000 of forgiven debt, that would be covered by the allowance for primary sale residence of $250,000. So that's one way of addressing the forgiven debt as income. Second way, Congress has passed a number of laws that acknowledge the fact that there is a substantial decrease in property values over the last several years. As a result of that, people are ending up with this problem of forgiven debt that's not actual income. And so that phantom income is acknowledged by Congress as not taxable because it wasn't revenue that anyone's received. And so the laws that were passed in 2007, 8, 9, and so on, all that address this issue of forgiven debt are intended to make allowances for that. So by properly placing the information, usually on Form 982 of your tax return, that information is reported as forgiven debt in insolvency or in a liquidation setting or as a primary residence, etc. But so long as it meets the criteria, then those laws allow you not to have to address it as income, even though it was forgiven debt. So that's the second one. Now the third one has to do with the treatment, usually of a piece of property that was not a primary residence. And it may be that you want to take this approach even though it was at some point in time. But if it became an investment property, then you would want to treat it in a capital gains or a capital loss sense. So this is how that works. And capital gains is really pretty straightforward. When you purchase an asset, there's a certain amount of cost associated with it. The acquiring cost, the cost of commissions if there were any, the cost of due diligence, of escrow, so on. Those are the basis for the asset. And then when you sell it at a certain cost. And the difference between them represents the gain or the loss. So this applies to the purchase of buildings, the purchase of stock, the purchase of vehicles for a business, or any other capital asset. And the law says that when you sell that asset, you can subtract the basis, and then you have to add on a few other things like the depreciation if there was any. But the difference between what you sell it for and what you paid for it, the difference is either a gain or a loss that is taxed at a capital gains rate. So let's go back to our real estate example. If we have a piece of property that we purchased for $300,000, we have debt of $300,000 on it, and we sell it for $125,000, then in this case, this capital asset has a basis of $300,000, and our gain is $125,000. So the net capital loss here is $175,000. So we lose that $175,000 as a loss. But remember, that's going to be forgiven debt. And in this case, $175,000 is also our forgiven debt. And so the the loss of $175,000 offsets the gain of $175,000. And so our net gain on this total transaction is zero. So on our Schedule C, we would report the basis, the gain, the loss, and the net of all of those would be a zero transaction. Now that assumes that it was 100% financed. If you actually put money into the purchase of the property, then you would have had a larger loss than the forgiven debt accounted for. And so you'd actually show a loss on the property and a net capital loss on your Schedule D that would actually allow you to offset any other capital gains or, to a certain extent, your ordinary income. So in the case of a piece of property that is treated for capital gains purposes on your Schedule D, it may actually help to offset other income depending on the circumstances. But in any event, if it's an investment property, not a primary residence, and it doesn't apply under the primary residence exception or the other laws that would allow forgiven debt to be absolved of tax treatment, then it still can be addressed under a Schedule D arrangement. So using one of those three approaches with real estate debt, you can address the debt. Now the same thing applies for debt that is forgiven in a credit card or another consumer debt kind of an arrangement where the debt was settled and then some was forgiven. In every case, there is a way to at least offset or excuse the forgiven debt that's resulting in the gain. So there are obviously a number of circumstances here that have to be evaluated and addressed. Every situation is different, and each circumstance would have probably a few specific nuances. But the general concepts I've covered will address the majority of those. So that's how you can ensure that you don't have tax liability. But I emphasize again, so long as your taxes are prepared properly, that will be the case. If you have any questions or concerns or comments about any of this, please feel free to contact us, either call us or email us. And we hope that this information has been useful. We wish you the best. Thanks.